Interest rates. This is the number one determining factor of the movement of a currency value. All of the economic indicators mentioned before gives insight into what the central bank will do regarding interest rates. As we discussed earlier, the central bank can control the demand and supply of money by increasing or decreasing interest rates accordingly. Bear in mind that an investor would want to have or own a currency which has the highest return. An increase in interest rate means two things. Firstly, let's look from the consumer's point of view. An increase in interest rate means that the consumer now pays a higher rate for their debt, and as a result their disposable income has decreased. They now have a higher demand for money and require more money to purchase the same amount of goods, and hence the currency value has increased accordingly. Secondly, from an investor's point of view, it means that an investor would like to get a return on his investment which offers the highest return. An increase in interest rates means that he will receive more money, more income, or return on his investment. As a result, this means that the supply of money has increased because investors would put more of their money to generate a return accordingly. Events leading up to interest rate changes will create drastic moves in the Forex market for the particular currency pair. Sometimes, even if information is leaked, it will create extremely large movements in the market, so it is important to understand this. Generally, the information regarding interest rates is public information, so it allows us to get insights into what is happening and take advantage of these opportunities. Quantitative easing is a method which is a type of monetary policy employed by a central bank of an economy to control inflation and interest rates. There are numerous reasons and methods that this is done, but basically, what the central bank is doing is buying non-treasury securities in the country in order to inject a supply of money into a specific economy to help boost the economy. A nice example that I'd like to use is the eurozone quantitative easing policy that was employed by the European Central Bank in 2008. The eurozone has been plagued by economic troubles since the Great Recession in 2008, which led to what some people refer to as the Pigs Nation, or Pigs Nation, which is Portugal, Italy, Ireland, Greece, and Spain. A lot of Forex traders sometimes refer to this as the bailout boys. As the central EU nations recovered, the peripheral nations still needed bailouts, especially Greece, who had the biggest problems in the eurozone. In 2008, the euro reached an all-time high of $1.6 per euro before this started coming down. Recession dropped it down to about $1.2 per euro. The data shows that the value of the euro was declining steadily in the year leading up to the decision to undertake a quantitative easing policy. Its value has fallen an additional 16% since to around $1.05 per euro, price levels not seen since the early 2000s. Inflation levels in the eurozone have been historically low in recent years, with some countries even experiencing deflation, a general decline in price levels. Deflation is a bad thing for economic growth, as it is indicative of low aggregate demand and underlying weakness in production and output. Individuals and businesses stop spending and investing and begin to hoard money as a safety cushion against further declines in asset values. Companies lay off workers and unemployment rises, preventing an economic recovery from taking place anytime soon. As expectations that low prices will stay persistent, people choose to hold on to money rather than spend it, as perceived value will be greater in the future. Credit and liquidity subsequently dry up and the situation descends deeper into recession or depression. This is known as a deflationary spiral. When prices drop like this, central banks generally employ expansionary monetary policy tools, but in severe cases, quantitative easing is required. The ECB is trying to prevent a deflationary spiral at all costs, and some banks in Europe are even going so far as to implement a negative interest rate policy. If deflation is when goods get less expensive to buy, that implies that the currency must be getting stronger. If this is the case, why is the euro still weakening? One important piece of the puzzle is the lingering threat that Greece will exit the euro. A new anti-austerity government has been butting heads with the European finance ministers, and now more than ever, the threat of a Greek exit is real. The consequences would be disastrous for the euro, as other peripheral nations could decide to follow suit and the dominoes will then fall. Greece's economy in and of itself is not very large. However, the ripple effects of contagion from a Greek exit would be widespread. As a result of these developments, the increased risk of such a move by Greece is being factored into the euro exchange rate, weakening it against the dollar. QE itself is surely to have some impact on the euro's value, as its intention is to decrease the value of money in order to spur spending and investment. Quantitative easing, however, did not significantly increase annual inflation rates in the United States after a number of rounds and over a period of many years. The likely reason is that while QE increases the monetary base to shore up financial institutions' balance sheets, the data shows it does little to create new credit through fractional reserve banking, which is arguably a much more important metric when looking at price levels. Quantitative easing being undertaken by the ECB in order to stabilize the eurozone economies is sure to have some impact in decreasing the value of the euro. That said, the euro-dollar exchange rate has been falling steadily for more than a year leading up to the decision to begin QE. The real threat of a Greek exit and the contagion it will cause throughout the rest of the periphery is one factor that has been contributing to this extended decline. While QE is likely to have some effect on the euro's value, many rounds of quantitative easing in the United States has not led to a great deal of inflation. Quantitative easing is meant to stave off deflation and prevent the eurozone from descending into a deflationary spiral. A bond is a debt contract or an IOU agreement issued by government when it needs to borrow money. Government issues bonds in order to boost the economy or raise capital to operate the government of new projects, to create employment, stimulate monetary policy. If you own a government bond, the government has essentially borrowed money from you. Is this not the same as owning stocks or shares? Well, bonds have a set predetermined time to maturity. The owner of the government bond will get paid back the original borrowed amount as the principal on a set date. When a bond gets purchased, the investor also gets paid at an agreed rate of return at a certain time intervals, which is called the bond yield. The payment which is received from investors is called coupon payments. The bond yield is the rate of return or interest received for that bond and the price he paid, called the bond price. Bond prices and bond yields are inversely correlated. When one goes up, the other goes down. But what does this have to do with Forex? Bond yields serve as one of the best indicators of a country's stock market, which increases the demand for that currency. Bond yields are the best indicator to determine the direction of countries' interest rates and expectations. If the government of one country is offering a higher bond yield than another country, it means the demand for the first currency is much higher, which increases the price. Furthermore, it means that investors want to put their money into the country which yields a higher return. Hence, the demand for that currency has increased, and so should its currency value. It is important to remember that we are comparing the bond price of one country's bond yield to another, for example, the US dollar versus the South African rand. The bond spread is the difference in bond yields between two different countries. By monitoring these spreads and expectations for interest rate changes, you can identify where the currency pairs are headed. If one country is offering a higher yield on its bond, it means that there is a higher demand for that specific pair over another currency pair, and hence the demand for that currency has increased, which hence increases the pair accordingly. For example, when bond spreads increased between the Australian dollar bonds and the US treasuries, traders started to purchase more of the Australian dollars and go long.